When Reagan took over the presidency, American economy saw some of the biggest growth in decades. The finance industry was prospering, attracting hundreds of thousands of young men to partake in the market. Steve Cohen grew up poor, but through years of hustling, he became the star trader at a trading firm called Gruntal. During this bull market, Steve Cohen was raking more profits than anyone. But little did he know, a financial bomb is about to explode. Economic growth has slowed while inflation was still high. The strong dollar was putting pressure on exports. The valuations for stocks have gone up to excessive levels, with overall PE ratios above 20. Future estimates for earnings were lower, but stocks were unaffected. All these conditions created a perfect storm. The Black Monday stock market crash of October 1978 saw US markets fall 20% in a single day. Gruntal, along with many other firms, was practically put out of business. Cohen's group lost almost half his capital. Every one of his 7 traders was nearly wiped out by losses. We see blow-ups like this all the time. Sure, some traders might have some skills at predicting a stock, but once in a while, a market can change fundamentally. And when that happens, you lose everything.
A really great trader, what he does is he smells the fear. And what he does is he organizes himself to be able to take advantage of others' fears. Okay? And ultimately what happens there is he's disciplined. He's not acting from statistical analysis. He sees that as something, but what he's developed is an intuition of being able to see the supply and demand, and he knows the blood there and he knows where they're trapped. That's state of mind management.
As the chaos continued around him, he stayed in the game, actively trading to recoup losses. He ultimately survived the crash. But Cohen grew tired of Gruntal. He wanted to start his own shop instead. With the hedge fund structure, Cohen has the potential of making more money with less restrictions. In 1993, Cohen started SAC with around $23 million in capital and 9 employees. He put in about $10 million of his own money, and his traders and friends and investors put in the rest. Although Cohen's trading strategy is hard to emulate, there are some essential principles he always follows. Taking the lessons from playing poker, Cohen believed that investing is all about smart risk-taking.
And he was very good at managing risk. He didn't get emotionally attached to his trades. He was very good about sort of pulling the plug and selling something if it just started to go against you. And, the kinds of situations where a lot of people will end up just losing more and more money because they don't want to acknowledge that they made a mistake. He was, according to everyone who worked with him at the time, he was very good at just being kind of dispassionate and analyzing risk in this very cool, detached way. And he just started to make, a lot of money, millions of dollars, very quickly.
Within 3 years, SEC had quadrupled in size to almost $100 million. Cohen started buying mansions and expensive arts. He may be on top of the world, but he fails to see there's a crisis looming. The late 90s and early 2000s saw the biggest growth of hedge funds. By 2012, there were more hedge funds than public companies. Right at the top of the hedge fund kingdom was SAC, one of the most profitable shops ever. Born and raised in a middle-class family, Steve Cohen built SEC Capital from scratch, making billions in the process. The success of SEC draws admiration and envies for Wall Street, and also from places Cohen didn't expect.
Anyone working at any hedge fund who involved in short-term trading, meaning every day they're coming and trading in and out of stocks, all of those people want edge. That is a common term in the industry. They want edge. And, there's this white edge that's kind of useless for their purposes. There's the gray zone. And then there's black edge, which is clearly inside information.
Since the advent of internet, information has become widely accessible, making it tougher to beat the market. Now, a great majority of the academics believe that it is impossible to ever outperform the market. Those that seem to do well are just lucky. In other words, the market is highly efficient.
Prices basically reflect all available information, so that in a strict view of the theory, it would say it's basically impossible to beat the market. You're always paying a fair price, basically.
I think there's a merit to the argument that it is virtually impossible to beat the market. I think some of these hedge fund managers know that. That is why they're looking for an information that gives them the edge. And unsurprisingly, many of them resort to insider trading. One hedge fund manager, Raj Rajaratnam, realized that as well. The only way to beat the market is through cheating.
Prosecutors want the toughest punishment possible for this man, the convicted founder of the Galleon hedge fund, Raj Rajaratnam.
In 2010, billionaire hedge fund manager Raj Rajaratnam was sentenced 15 years in jail for insider trading. But soon the prosecutors realized he is just a small fish, and there are bigger sharks to catch.